The Reserve Bank of Zimbabwe set the world's highest lending rate in June to tame speculative borrowing and contain money supply, which it blamed for exchange rate volatility and high inflation. The exorbitant rate has left businesses in a pickle.
High interest rates mean that people have to pay up loans, they have to pay them up very quickly. They have to stop if they had plans of borrowing to expand or even to just get working capital, they have to stop that. And unfortunately, some people were already borrowed, so now they are having to pay those high interest rates, even for businesses that were not borrowed. The problem is that a lot of them were also working, either they were working with businesses that were borrowed, which are now unable to pay them, or they are being affected by the slump in demand.
Though the exchange rate has been stabilized and inflation lowered, business says the central bank should not be preoccupied with these two measures alone. Business is concerned that the short-term benefits may be outweighed by adverse impact in the medium to long term. They say some firms could buckle.
If we have another couple of months of these sort of interest rates, certainly you'll start to see casualties. You'll start to see businesses failing or businesses succumbing to the high interest, whether to the high interest rates or to the depressed demand. You'll see a lot of unemployment because people will have to retrench.
But the rate looks like it's here to stay.
The central bank is of the view that interest rate or the tight monetary policy stance would have to continue until the job is done. As it is currently, we feel inflation is still high to warrant any further reduction in interest rate. Those that feel the interest rate in Zimbabwean dollar is a bit high, they've got an option to borrow in US dollar, where interest rates are around 10%, thereabouts.
Businesses have been reluctant to borrow in hard currency because the bulk of transactions are done in Zimbabwe dollars.